coming. I'm going to get you to introduce yourself. If we start with you, Nicola, what you do, where you do it, and your name.
Hi, I'm Nicola Piercy. I'm the co-founder of Stripe and Stare. We are renowned for making the world's most comfortable knickers, as well as all underwear and sleepwear. We've been around for about 8 years now.
Amazing.
I'm Rob. I'm the head of women's health and longevity at a company called UltraHuman. We're the second largest ring manufacturer worldwide of wearable rings. And I just exited to that business in the middle of last year.
Hi, everyone.
Oh, go on.
Hello.
Yeah.
Hi, everyone. I'm Eli. I'm one of the co-founders of a company called Wype. We're an intimate personal care company focusing on anal and perianal health. You did hear that right. That's our thing. We're e-com heavy, e-com first, omni-channel. Most of our sales come through DTC and Amazon, and more recently, a launch in Holland & Barrett on the High Street, and another one, nationwide retailer to come in about a month.
And Ellie, same with you. You know I love a stat by now, but 120% year-on-year growth since 2023, and 350 store listings at Holland & Barrett. Woo! Okay, so jumping straight in, what financial discipline enabled that 120% growth without losing control?
Yeah, so for us, it's been a real sort of balancing act between pushing growth as hard as we can without kind of falling off too far off the back with cash and with margin. So we are cash burning by design. We're venture backed or equity backed, so we do have that luxury. But it's been very much about seeing what we can achieve, figuring out when are the right moments for us to be able to really lean into investments, into different types of acquisition, or having big swings at things when our cash kind of allows it, and figuring out when we need to be a little bit more conservative. I guess really key to that is having a very, very good hand on, or finger on the pulse of our financial performance, our financial health. So getting really involved in the day-to-day, really understanding what's going on in the P&L, what's going on in the cash flow, and making decisions around that as much as we can.
Yeah, I think the numbers can be daunting sometimes, but it's important we look at it. Rob, so what does acquisition ready actually mean in regulated health categories?
Well, for us, I think it's fairly obvious. You've got to build a product that is actually capable of passing those regulations to begin with. And then largely it's about building trust with your user base, and from that building enough data to exit. I mean, we exited for a number of reasons, but one of them was the data that we'd created over 10 years in the market. So building data in a regulated environment, but making sure that your product passes those regulations in order to get on the market to begin with.
Fab. And Nicola, so Ellie's just mentioned keeping your finger on the pulse with the financial side. What financial metric do founders ignore at their own risk?
Oh, so many, so many. Obviously, the main one is cash flow. You've got to keep a handle on your numbers, especially when you grow. But I've spoken, I mentor a lot of businesses, and certainly in the early stages of growth, your entire focus is the product, getting it out to market. What does it look like? How do you sell it? And, and a lot of these people are sole founders, so that is their strength. And that's what they focus on. But you get to the numbers where, it really does matter, and those increments really matter. So, I spoke to a business, and she's 400,000, doing really well, didn't have a cash flow, didn't know what her revenue was, didn't know what her product margins are, was lost and just like, I don't know where to go next. And it's like, okay, well, let's break down every number in your business. And what is your product margins? What are your best-selling products? What do you sell the most of? What margins are, what products aren't you making a profit on? All of that, understanding your data, means you can then make sensible decisions going forward, and tracking your data. Conversion rates, everything else. Yeah, all
I think the big numbers are impressive, but they need to mean something, right?
Absolutely.
Nicola, same with you. So how do you balance reinvestment with profitability?
It's a good one, and as you just said, you're making a loss for a reason, because as we all know, it costs a lot of money to acquire these customers, and so one of a good model to look at is your cost of acquisition versus your lifetime value. So if that's over 3, then your growth is good and you've got lots of room to breathe. But it really is just looking at those numbers, making sure, do you want to be profitable on your first order? How soon does your customer come back? When are you going to get that profitable order? How does that work in your cash flow? How does that work buying stock? It's all of it. So you really have to have a sensible handle on the numbers and make decisions on everything. Yeah.
Definitely. I've just laughed at this question. It's for Ellie, but it's bringing back Ollie and the lean team. How do you approach lean financial planning as you scale?
Yeah, I think financial planning is probably one of the least sexy parts of running a business, I think, of being a founder, but I think it's probably one of the most important. I think having somebody, either one of the founders or somebody in the founding team that's got a really good handle on it. We certainly didn't at the start. It's something obviously if somebody comes with a background of it, it's great. If they don't, there's plenty of ways to learn and upskill yourself to be able to be comfortable enough early stage at least. But it's just so important that somebody in the leadership team of a business of any size has a good handle on it, and that can see you through. So we're just about to bring on a fractional finance team we've been running for about 5 years, and we've just about been able to get there through myself looking after it internally.
Amazing, exciting. Rob, why do promising startups fail at exit despite strong traction?
Well, I think not planning for exit is a real problem, right? And it's a particular problem in the UK versus the US. So planning for an exit from day one, is that really what you're thinking about? A lot of people are not. I would say building a robust enough data room, which is a useful thing to keep live anyway in the business, because at any point in time you may be asked for that information. So planning for exit is important. Why do they fail? I think a lot of people don't understand the journey to an exit and why you exit in the first place. Most people think it's about making lots of money. In actual fact, the primary reason for exit is to do something that you couldn't do yourself with money from somebody else's money, right? And for us, it was about getting 100 times the number of users we previously had. We had a women's health product, class 2 medical device, vaginal sensor, quite difficult to sell online, but we were selling at DTC. The only way to get that product into the hands of many more women was to take those algorithms and put them into a wearable device. And we started planning for that when wearables started coming out maybe 2.5 years ago. So it became part of the way in which we were driving our numbers, not just revenue growth, but user growth with data.
And sort of leading on from that, Rob, how early should brands think about diligence and compliance?
I think I answered that already.
Yeah, early.
But early, and it doesn't mean, I think like you were saying, it doesn't mean you have to be experts at it to begin with, but learning how to put a data room together. It's dead easy to put a data room together, right? But people are frightened by things they don't know generally in a business, and I think learning to go into the places in your business that you're most uncomfortable. I think that was one of the biggest lessons I had moving out of corporates and into startups.
Amazing. And back to you, Nicola. What red flags do investors consistently look for?
Well, I think they're probably quite few. I mean, if you're not passionate about your product, that's a pretty big red flag. And you don't know who you're marketing to and what it's for, that's a pretty big one. But certainly kind of post-funding and post-revenue, it is about the numbers. Even if the founder is the creative, they still need to have someone in the business who understands the numbers. If you don't have that person, that is a red flag.
And speaking of the funding, Ellie, when is angel funding better than VC?
Yeah, so they're two very different types of investors. I think it's two very different horses for different courses. I think the upside, in our experience anyway, I'll caveat that with a big in our experience, but angels tend to be a little bit more hands-off, but typically have a lot more experience. They're typically people that have either run a venture themselves or have done quite well professionally in some other form and have a lot of experience to share with the business, whereas typically in VC, while there's definitely very experienced operators within the fund, quite often they're not your day-to-day, and they're normally a lot more junior, a lot more finance heavy. They might not have had like hands-on experience, so the value that they add to the business, in our experience, has not been as helpful, I think. But certainly VC have much deeper pockets. They're able to sustain much bigger valuations, and I guess typically angels. And VCs obviously take much more control. So VCs will normally expect to be able to control most of the important things that you're able to in the business, whereas angels won't. So in our experience, VCs start to make sense once you get a little bit more mature. But certainly at the start, angel funding, although it can be a little more tricky, I guess, if you're raising a whole round, of one VC might be able to take the whole round, so it's a little bit less work if you're quite good at fundraising, whereas it might take you 20, 30, 40 angels to get over the line. So there's pros and cons of either.
Depends what your goals are.
Exactly, yeah.
Nicola, how did you structure operations to support sustainable growth?
Chaotically. I think every business starts with with a tiny warehouse or a sitting room or whatever that looks like, and you learn and you grow as you go along. So we've definitely had we do our own fulfillment. So the previous panel, we do all our own fulfillment. First couple of years, we didn't have a clue. I was in charge of the warehouse. Never run a warehouse. Never been in a warehouse.
Best way to learn.
Exactly. And and then after a couple of crazy sales and everything else, we turned it into a smart warehouse. We've now got 14,000 square foot smart warehouse that we run ourselves, and that is able to grow significantly. But it takes time.
And Rob, last one for you. So, what separates credible growth from fragile growth?
I looked at this question again today, and I'm not sure I know the answer.
Okay, that's fine. We can try.
But I'll give it a go. I think, and partly the problem is you don't know until you've found out that it was fragile growth, right?
Yeah.
Sometime. But we got hit very hard by COVID. So most brands seem to do quite well in COVID, partly because people were at home and they, online shopping. Our VC told us to turn off all marketing spend, right? Because they were very fearful that all of their businesses were going to go under during COVID. And we never kind of recovered from that. We were actually on a significant growth at the time. We were on 120% growth, and we never really recovered from that. So we turned that growth into something else. We turned it into acquiring data and making sure that data was something that could be published clinically, so that we were able to then exit on the basis of something else. So.
Yeah, hindsight's a wonderful thing, isn't it? Okay, got a quick fire round for all of you. We'll start with you, Ellie. What is the fastest way to damage a brand financially?
It's probably quite a few. I think the fastest way is if you don't have, and I guess I keep harping on about this, but if you don't have a very clear understanding about the financial position or the financial health or the financial metrics of your business, and you're using that to make decisions. So, you might not fully understand what your contribution margin might be across your channels, and you're making investment decisions on CAC, for example. With that information, that's going to be really, really damaging. So I think it all comes down to having a really, really granular understanding of the financial aspects of your business, of the key metrics, and making decisions based on good quality financial data.
Amazing. Rob?
I didn't realise I was getting the same question.
Oh yeah, sorry, you all getting
So I think one thing that was really key for us was customer support. And we invested very heavily in it early on. We had customers that were trying to conceive and were generally struggling. That's why they bought our product. So I'm kind of flipping it on its head and saying we realised we needed to do that, and we thought it was absolutely vital to hold the hand of the customer. And we had lots of competitor brands that were not looking after their customers, and that's I think why we were successful.
Nicola, hard job now.
I'm going to go with cash flow. If you don't have a handle on your cash flow, it's impossible to grow, especially with a stock business. You've got to buy stock at the right time. You've got to spend money on advertising, how much money you spend, what that looks like, VAT bills, all of that, peak troughs, peak sales. If you don't have a handle on your cash flow, you'll run out of money, and then what happens?
Thank you so much. I think, well, what you've all summarised is it's not, scaling isn't just about that revenue. There's so much more to it. But thank you so much for joining me.
Thank you.